QG chart, on TradeStation chart, as well as the candle volume charts on the Photon platform. So you can see there's many ways to skin a cat. Yes, I've known Damon since 1991. He used to do execution in the S&P pits, so he did a lot of my fund execution. I've used the Photon platform since 2000 for my hedge fund, but you'll see all kinds of tools can provide similar information. As he's getting this up here, what we're going to do today is to look at several things with volume. For this presentation, I'm just going to stick to short-term scalping, and we're just going to look at 1-minute charts primarily, just for a taste of it. You'll see, though, that the volume concepts will actually apply on any type of time frame. It's just this will give you a little preview, and you'll see that you don't always, for scalping purposes, we don't always need to sit there and have a billion indicators and time frames and everything like that over the charts. I want you to see just how much you can see with a simple bar chart. No moving averages, no oscillators, no gobbledygook. Now, in the old days, tape reading traditionally was monitoring the market for aberrations. Yep, it wasn't watching every tick in the tapes. The guys would sit there in the bucket shops and they'd watch the tape. For any large volume print, perhaps a block would go up of 50,000 shares back in those days. When I originally stood in the options pit in 1981, we used to have a ticker tape running across the floor, and we'd always keep our eye out for the big blocks, 500,000 shares, 250,000 shares, because that would alert to something going on. Of course, we don't see that anymore. The average transaction size in equities is now 100 shares, down from 2,000 shares 12 years ago. So definitely it's a changed environment, and you can't see those type of footprints anymore with the blocks. But on a short-term time frame, you can see many different interesting things. Volume comes in 4 main patterns that we're going to talk about today. The first, as you can see on the slide, is a volume reversal. Simply, there's no structural context in the chart, but we see a dramatic shift in the supply-demand imbalance. So this is a change of character. So volume, as you know from Damon's foundation, signals something going on, or perhaps a higher time frame player stepping in. Next, we'll look at a volume breakout. Everybody knows about the breach of an obvious support or resistance level, and as with traditional bar charting, we look for an increase in volume as confirmation. So think about that right there. Volume equals confirmation. Now, in this context that we're going to look at today, it may just lead to a simple push down or 3 pushes before you get a reversal. So it's still, even though we have a volume breakout, it may or may not lead to a sustainable move. Remember, for today's purposes, we're just looking at simple day trading patterns. I try to do 2 or 3 of these scalps every morning. I prefer to do them in the morning session, and what I do is I find that it gives me patience while my longer term positions are working. Same thing with my S&P scalps. I push myself to do 2 or 3 S&P scalps a day. It smooths out my bottom line and is value added. But I think you'll see just what fun this can be. Next, volume continuation pattern. This is our simple bull and bear flag continuation, which I'm sure everybody is familiar with. And lastly, a volume climax, increase in range and volume at the end of a strong swing. After you have a volume climax, you get one of 2 outcomes. You either can get that dramatic V spike reversal, or you get a small retest with a volume divergence. Many recent tools in the marketplace, such as Market Delta and so forth, all try to capture this type of volume divergence. You'll see that there's many ways to see the exact same thing that you would on a Market Delta chart. Usually you'll have an oscillator divergence at exactly the same time, as well as a volume divergence. So we'll look at some ways that we can see this. Now, before I go on, I just want to, how do I get this up or down? Okay, for modeling purposes, we always try to quantify things first. Okay, I do believe in discretionary trading. Most of my actual entries and exits are discretionary, and it is shown that human beings can process patterns better than a computer can, which is just using rule-based systems. Of course, the advantage of a rule-based system is that it eliminates the emotions and unforced errors. So two sides to every coin. Still, we always do model the volume, and I'll show you the ways that I do it. I'm simply measuring volume spikes as a certain standard deviation function to the moving average of the volume. This puts it in context so that if you're in a slow night period, you could still get an extreme spike that would be pertinent then. However, that same spike would not be considered to be statistically significant during our trading day. So we do modeling on this stuff. About 80% of the time, it does lead to some type of continuation. That is an increase in volume, and we model it. If you have a volume spike, what happens 5 bars out, 10 bars out, 20 bars out, 40 bars out, etc., etc. So it's pretty durable and robust. However, with that said, I think you will agree when you see my slides that the pattern recognition in and of itself works just fine. As with anything, such as machine-based learning, the more patterns that you study, the more examples that you look at yourself, the better you will be at getting this in context. All right, so, and then lastly, keeping stuff at time of day as an important consideration. So just as references for you, because I believe in giving people tools for themselves. Gartley did some of the original work on volume. Mark Leibovitz wrote a good book. And if you like our candle volume charts, Dick Arms originally published something on equivolume charting. Now take a look here. Let's start off with this TradeStation slide. Do I have a mouse right here? Okay.
It's right here.
You can see this initial bar right here that I've got in big blue cyan color. This is TradeStation, and you can see at the bottom, this was actually a paint bar that was created when we had a large standard deviation spike in the volume. Now notice, I filter out the opening price, okay? I know I'm speeding up and I talked very quickly. I just wanted to get through that as an introduction, all right? Boy, come to an hour webinar and I'll get you really spinning there. All right, so anyway, you can see on this day, which was actually Friday, we really only had one volume spike, which represented the upside breakout through this previous resistance area. And you can see that the first poke up right above there, which actually took out that high by a tick, did not show any increase in volume. However, this bar right here showed the big increase in volume. Now, for scalping purposes, for those that are nimble, you can get a first pause, very short pause there. That's just a 4-minute pause. And at this time, you had very supportive market internals in terms of breadth and trend of RVX and so forth. Or if you prefer to wait for a little bit better pullback, there you go. Bingo for your retest backup. Now, on these volume breakouts on short time frames, what we found is that there is nothing statistically significant that indicates a much longer term trend. Like I said, we did our modeling 10 bars out, 20 bars out, 40 bars out, 100 bars out, etc. Most of this stuff leads to very short-term scalps or trade in the range of anywhere from 10 minutes duration to 30 minutes duration. So keep that in mind. This is just having some fun short-term in the markets. And what you've done is you've filtered out the noise in the market and the flat time so that you're initiating trades only when there is something unusual happening going on. Remember, the aberrations in the market are what create opportunity. So let's move on here, and I wanted to show you, these are some CQG charts. Now at the very bottom in pink, you see an indicator that we created on CQG that again is a standard deviation function on the volume so that we can get an alert that will indicate when something unusual is happening. So we've got two initial setups here where we had a breach of the support level. And you can see it led to continuation to the downside. And lastly, the third push down was a sell climax. Now, the question that we are going to address in this particular webinar is, how do we know when it's going to be a breach of support leading to continuation versus a climax such as you see at the end? And we'll just give ourselves some very basic guidelines and then what to do when we do get a climax. All right, so those are the questions that we are going to address. Lastly, I'll just show you one or two more examples of the types of volume that I was talking about, volume patterns, before we go on and answer that question. Here on the Australian dollar 1 minute chart, you can see we had our flag in the early AM session. I like to start my trading actually at 7 a.m. Central Time. I find that that is when there is the most opportunity in the morning session for me. Of course, the E-minis in and of themselves are a different story, but if you're trading gold and crude and a lot of these other markets, there's actually very nice reversal points or breakouts that start around the 7 a.m. time frame. At any rate, in this particular case, you can see there's no structural context here. Granted, even though it's in the wee morning hours, it's not like there's a break of support or resistance. So it's not a breakout trade, it's not a climax trade, but this was an example of what I was talking about in terms of change of character. Something is happening. Perhaps it could be that start of the higher time frame players that Damon referred to stepping in. The market here just said initially, okay, somebody's coming in and they're starting to do an increase in selling. Eventually, this is what we were looking at for the sell climax, and you can see how lovely that shows up on the little flag here for our alerts. Now, this was a case where we did get a retest down, a volume divergence, and a reversal back to the upside. So selling climaxes, first of all, tend to happen at the end of a swing. We can recognize that. We've been selling for at least 3 hours of duration here from this high to this low. I find that the cycles in the market on these swings tend to last 2.5 to 3 hours duration. The thing to catch yourself with is that a lot of times when we have these volume increases in the market, all right, it tends to trigger people's emotions. I don't know how many of you have ever felt very reactive when you have an increase in volume. It's almost like you want to join the party too. Gosh darn it, you weren't short. Let's sell some and see if we can scalp it down a little bit lower. So at the very least, you want to be aware that this increase in volume, if it's at the end of a swing, is just sit on your hands if you're not in the market. The next thing is that if you have an existing position, fabulous time to take profits on a volume spike. Yes, you may get continuation to the downside. However, it's pushed the market's value beyond the way beyond the mean that it should be. You'll see that almost always. So fabulous time to exit a position on a climax, which would be signified by an increase in range and or an increase in volume. Now, obviously the volume divergence at the bottom is accompanied by the volume divergence in the oscillator. I don't want to get too much into that. It's sort of obvious after the fact here. And that's the problem if you don't do your own work. A lot of stuff is obvious after the fact, but I wouldn't be doing my job if I didn't show you cases where you can get tripped up and you can get stopped up. I always make it a point when I look at any method or indicator to examine the times that it didn't work as well. Very important. So here's a case in the EC where you see at the end of a little push up, we had a volume climax, range expansion, increase in volume. It was not a new breakout. The market had been uptrending for a little bit. Again, great time to take profits if it's at the end of the swing. Here was a case where we had a volume spike to the downside, and I would have looked at this pattern here as a possible continuation pattern. Why? Number one, It was a fresh breakout from this equilibrium point, a triangle. After a triangle, you almost always will get a little retest down. Number two, it wasn't at the end of an extended selling wave that lasted 2 to 3 hours in duration. And three, you had taken out this previous support level. So here's what would have happened on a bad trade. You could have shorted right in here. I always like to look for the little ABCs up before initiating, and I usually stick an offer out, or sometimes I'll just bang it at the market if I feel that it's an urgent market. And then I'll put an initial stop just a couple ticks up higher up here, and you can see eventually this would have gotten stopped out. So always keep in mind with any methodology, it is a numbers game, okay? As long as you're winning more than you're losing, and in this particular type of short-term trading, you need to have your wins a little bit greater than your losses. So be realistic there. Now, this next example here shows an increase in volume, which represents that change in character that we were talking about. There's no obvious breakout from a chart point yet. By the way, this increase in volume here initially on this little alert that we got was right on this bar here. It's not a breakout. It's not a climax yet. It's not a flag pattern. It's a change in character. So something's happening. New players are coming in, and that's something to be note of. And here is our breakout bar when we took out this swing high here. All right, and then this is your pullback on the lighter volume that formed your continuation pattern. Please note one thing. The continuation patterns are fabulous. They are scalps only. You will do better if you exit on a retest or a push back up as opposed to trailing a stop. That's what all our modeling shows. So for me, for short-term scalping, I go all in, anywhere in here. I put an initial stop of a fixed point away. In the S&Ps, I'll always risk 3 points initially. I can tighten it thereafter. In the currencies, I'll put an initial 25 tick stop. It goes in automatically, and then I can quickly tighten it up, and then I exit at the market. All right, so you see, that's my style for short-term scalping. Don't trail stops, all in, all out, and you'll find that in the long run, you'll have a more consistent approach without getting caught up in the brain fry. This is, again, short-term scalping. We're not doing the pattern recognition on the 5-minute and the 15-minute buy and sell divergences. That's a whole nother game. Now let me show you these change in perspective with the volume charts that Damon was showing. This is my CQG platform, and you can see this obvious breakdown of support in the gold. Again, these are just 1-minute charts that we're dealing with today. Now let me tell you something. This is a game that I play, and this is a game that algos play. I will almost always put sell stops beneath an obvious support like this. All right, I'll let it trigger me in, and I'll quickly scale out of part of it and then see if I get more on the balance. Not only do I do this, there are algorithms that do this out there on a systematic basis. I know how they're programmed. I have a friend who does them. I see them at work. Future Path's firm was originally started by Damon and the founder of Gecko. Gecko is one of the first high-frequency firms out there. So I know what games are being played out there. They're very short-term in duration. Obviously, something like this wouldn't be the higher time frame player. It's an increase in noise created by an algorithmic strategy. So just recognize that it's not somebody gunning for your stops. It's everybody's playing a similar game, and it's going to come down to how you manage the trade. Now let's assume that you didn't have a sell stop here, and let me just show you a completely different visual. This is pretty cool. Now this is the same chart on the photon volume platform, and you can see that it's got the same 1-minute bars with candle volume bars. And look at the huge volume that came in here. Obviously, you've got longs that have protective sell stops. You might have people that are initiating to the short side and so forth. even if you did not have a position on at the time, it leads to a very scalpable little reaction back up. And what you'll see more often than not when you get these breaches of supports is this 1, 2, 3 pushes down. So that's what I said when our modeling showed that this stuff is lovely for short-term scalping. Actually, I believe that gold closed back up towards the upper end of its range up here, and it came back up in here. So you can see it was just good short-term scalping only. So you can compare the two here. CQG, a lovely little 3 pushes down, as well as the photon candles. Another chart here, the 1-minute yen. Obviously, the triangle shows up on the 1-minute yen here. I told you that there are automated programs out there that take low volatility points. Most of them will do it in tick data, all right? And they are going to execute on breakouts. They don't care if it's a good breakout or not. They put their buy or sell stops, and it's managed by different algorithms. A human never sees this stuff, all right? But it will sucker you in too. And there's ways to scalp and ride the coattails of this as well. So look at the difference between this on the CQG chart versus the yen on the candle volume chart. Here was your same triangle. Boom, candle volume increases. Now, 2 things on these breakouts. We're going to monitor for 2 things. Continuation in volume. So we got big volume breakout, continuation in volume, little reaction up, and once again, 1, 2, 3 pushes down. Think of the 3 pushes as forming a wedge. Wedge is very often a short-term reversal pattern. Here was a case where we had an upside breakout in the soybeans. This again is a 1-minute chart. And I'll show you some higher time frames so that you can see that the same principles apply. Increase in volume on the initial breakout. You can see everybody recognizes this little Gartley type of formation here. This would actually be called a Gartley formation. And the increase in volume once you started to take out this high. Now I'm going to show you 2 more tricks as we go along, and then hopefully that will whet your appetite to come back for more. Okay, that's like me and desserts, all right? It'll whet my appetite to come back for more. The first trick is always make note of the high or low of the big volume bar. Your stops need to be above or below this. Very simple little rule of thumb on any time frame. Okay, these are the candle volumes. We call them candle volumes. Dick Arms did a book 20 years ago called Equivolume, and what it shows is they're basic candlestick charts, but the width is determined by the volume. So you can see the volume plotted underneath here. And this big volume spike up here has a much wider candle bar, all right, as the bars go up. And you can see the buying climax at the top here with this huge volume spike and then the little divergence. So this is actually the photon execution platform that I use. It has charting in it. And you can actually trade directly off of these charts. I can buy or sell at the market, or place limits or stops or trail stops right on the charts with one mouse click. So here's another example here in the wheat market. And then I'll show you what the little controls look like on that. The wheat market, where you had the increase in volume, all right, and dribble on up here with a dry up in volume. Now this was sort of interesting, and you can see the big volume bar up here. If you are looking to do a reversal trade, you want to short the market when it trades back below these previous big volume bars. So you can see a little bit of a volume reversal here. We had the huge flush down, and then we were able to start trading back above that. So if you were up, if you were trailing a stop here on the long, you would definitely want any protective stop pulled up beneath this big volume bar, okay? Very easy rule of thumb, and you can see what happened when we took out the low of this volume bar. Bam! Increase in volume to the short side. I love putting in sell stops below these big things if I do get hit, and a lot of times I get hit and I don't even know that it was trading there until I hear the little beep beep from my Photon platform. And then I'm just, okay, I'm in the luxury of in a moving market, and I can manage it as I see fit. Usually what I will do is on a breakout, I'll take part off the table just in case it was a protective spike, and then I'll work a bid lower to cover just some general area. Okay, so here we've actually changed the buttons on the Photon charts, but you can see I can just click buy and it'll drag a line where I want to buy or sell or stop anywhere that I want. So it's very easy just to click and place your order anywhere on the charts. And this was another chart. I just wanted to show you a few higher time frames before we quit for the day. And this is the Beans 5-minute. 5-minute charts work just as well. You can see it captures a more significant chart formation than our little 1-minute scalping thing. By the way, frequency of trade setups, always an important consideration when you are doing your modeling. So I find that with those 1-minute standard deviation spikes that I showed you, my frequency of trade setup tends to be 2 to 4 spikes a day. All right, if I'm getting anything more than that, perhaps I want to widen my standard deviation settings out so that I only capture the most significant events. All right, I do trade 90% futures. However, I love trading stock options as well. I make 1 to 2 trades a day with stock options, only dealing with the top 20 most liquid stocks, so I can stick to my style, which is like bang all in, bang all out, and it's pretty much on relative strength. And for the options, I actually have somebody executing for me, but I put it in a think or swim account. I also have IB, but I find I get very dizzy using their platform for options. So I'll stick to the TD Ameritrade for the options, and I always use Future Path with the Photon Trader for my futures because I do find that it is the fastest and most reliable. So here you see the beans on the 5-minute chart. This speaks for itself. Increasing volume means stay with that trade. Okay, lastly, as a parting shot here, these 3 pushes, again, increase in volume on the upside breakout. You have 1 pullback, the first pullback on light volume, second push up, pause, and third push up. This is another example of what I was talking about where the 3 pushes lead to a wedge type of formation. Once again, you could have put in an initiating sell stop at the low of that bar, and look how that ended up playing out. You could trigger a short and the market would never look back. As an aside, just for kicks, I plotted an oscillator on this. You could use a stochastic or a moving average oscillator, and you will see oscillators just show us what is there in the bar charts only. I promise you that if you were to study 50 different charts with this equivolume or candle volume or even basic bar charts, you can train your eye to see what's there in the chart anyway without the moving averages and the Keltner channels and the oscillators and so forth. Even though I like to use them in many certain cases, you need to also be able to understand that price is the fastest. Everything else, such as an oscillator, is the derivative of price. If you are good at just understanding price plus volume, I guarantee that you will be able to make a very consistent living without getting tripped up in the noise. So just to summarize 1 or 2 more things, this is just the last slide I have. It's a 2-minute S&P chart. Trend reversal. These are very basic technical analysis rules. Trend reversal comes from 1 higher low, 2 higher low. So you see the little ABC type of pattern up, increase in volume on the upside breakout from the ABC. That indicates a trend reversal. Pause on light volume until you have the climax at the top. Now, how do we know that this too might not be a little flag? You never know for sure, except we do know two things. A, we've had a rally here that's lasted in duration of 2.5 hours. Remember, that's our magic window, 2.5 hours for any swing. You better like pull in your horns. Okay, we've also had 1, 2, 3 big pushes up. So at this point, you would be needing a little bit better consolidation. Lastly, we do know that you could put an initiating sell stop below the low of that big volume bar and at least capture something to the downside. All right, so lastly, I always like leaving some resources for you. I mentioned that Gartley book and the Leibovitz book. You can Google Dick Arms Equivolume, and you can easily see, I believe it's $30 on Amazon. If you go to my website, I only send out emails maybe 3 or 4 times a year to notify you if I'm doing a special webinar. If you sign my guest book, I will send you an email when I'm going to do the next one. I also have a free manual on my site that you can download. However, it does not include our recent volume studies. If you're interested in more information on the photon charts or future path, you can contact my husband at the below email. And as an aside, we've been married for 4 years now, and it's very nice having somebody else that's in the business as well. I've been using Photon since 2000, and as you can see, I use a variety of products. I love TradeStation. I love CQG. I use the Photon for my execution in the futures. And please, you're welcome to email me via my website, and I'm happy to answer any questions for you. Thank you again to Morgan Busby and TradingPub. I am so impressed with what Morgan has put together. He is such a creative individual, and I thank him for helping sponsor us.
All right, very good. Thanks so much, Linda and Damon. Greatly appreciate you being here. It's a definite treat for sure to have you two on here. And again, guys, we did record that. I know it's a ton of information in a short period of time, and like she said, we'll definitely have you back for a future presentation. What we're going to do, I actually put this page together. If you want to be updated on future webinars with Damon and Linda, I put this quick little page together, and this will just get you added to the list. We'll make sure to get you updated there. So I'll put a copy of that right there. All right, so again, thanks again to both Damon and Linda. I had the opportunity in Chicago a couple weeks ago to meet with them and to get to talk to them about coming on here, and hopefully we'll be doing more and more in the future. So guys, at this time, I'm going to turn things over to our next speaker, is Nathan from Winner's Edge Trading. Nathan, if you can, go ahead and get your screen sharing going. We're doing pretty well on time, about 15 minutes behind, but considering everything going on, that's really, really doing well. I appreciate you guys and your all of your patience earlier with some of the sound issues